What's up traders? Welcome back to Investeen. As mentioned previously, this week's video is going to be about the CANSLIM investment strategy. People find it hard to believe that history can repeat itself when it comes to the stock market, thinking that this entire process is seemingly random. However, in the past, patterns have repeated themselves due to the market being driven by two fundamental forces, which are supply and demand. Now enter William J. O'Neill. He was just a young stockbroker in the 50s who wanted to differentiate between mediocre stocks and the extraordinary ones that saw huge price movements years later. So he created a defining set of characteristics known as CANSLIM. So today I just want to give an introduction to CANSLIM and elaborate on the first letter, which is C, current quarterly earnings. The other letters stand for A, annual earnings, N, which is new product, new highs, new management, then S, which is supply and demand, L, leader and laggard, I, which is institutional sponsorship, and M, market direction. These letters and their definitions will be covered in future videos. The very first, and if not the most important fundamental characteristic to look at for a stock to invest in, is its current quarterly earnings. And so the entire point of this channel is to demystify what this all means. And so instead of just laying out all the criteria, let's explore the definitions first. So for starters, what are earnings? Well, earnings just refer to the total profit or the net income that's created by a company through its operations. And so profit, for clarification, is just the total revenue subtracted by the costs that are associated with producing the product itself. And so we look at earnings on a quarter-to-quarter basis, and the metric that we use for CANSLIM is called earnings per share, or EPS. And this just represents the profit that's made by a company divided by the outstanding shares of stock that the company has issued. Now, for clarification, when I'm saying quarter over quarter, I'm not talking about the growth from quarter 1 2024 to quarter 2 2024. I'm talking about the percent change in the earnings per share from quarter 1 2023 to quarter 1 2024, or quarter 2 2023 to quarter 2 2024. And that's a huge distinction. And so the reason why we don't compare consecutive quarter EPS growth is because revenue spikes can occur due to seasonality. And seasonality just refers to the spikes or the fluctuation in sales due to some sort of external factor. And so, for example, let's take a leisure services company like an amusement park. They would always be seeing huge growth in Q2 and Q3 due to the summer times creating really high demand for the service from an amusement park, which are the roller coasters and the rides, right? And so at the same time, they see the same amount of growth each year, right? And if we're doing it like that, if we're looking at EPS like that, all that does is create faulty judgment for us that, oh, there's some sort of huge growth that's happening. But no, instead, by comparing quarter 1 of 2023 to quarter 1 of 2024, for example, we would be seeing the true growth that the company is showing. And so by looking at quarter over quarter growth like this, we're eliminating that external factor from causing us to have those faulty judgments and whatnot. Now, for what is being sought out exactly for these stocks, the CANSLIM methodology goes off the criteria of percent change quarter over quarter for the EPS being at least 25 to 30%. Even better, this growth should be accelerating each quarter. But then again, 25 to 30% is just the bare minimum. Companies with accelerating EPS growth with percent changes of 70%, 150%, 400%, and even in phenomenal cases, more, like Nvidia with 440%, 567%, 478%, and 455% are the ones that should be capitalized off of. And with this type of growth, institutions will just come pouring in, ramping up the price. These stocks are the one that, in most scenarios, have higher chances of displaying explosive growth. And you may be noticing that there are only a handful of stocks that are showing this type of growth. Well, the CANSLIM strategy was created for the purpose of finding the best stocks, which truly must be the cream of the crop. And the video doesn't just end here. There are some other concepts and limitations you must just take in regarding analyzing the EPS. So first off, vigorous movements in earnings should be supported by just as vigorous of accelerations in sales growth. The CANSLIM strategy itself suggests that sales growth should be up at least 25% for the latest quarter, along with huge growth shown in prior months as well. And this is really backed up for Nvidia, as we can see 262% growth in sales just for the last quarter, which is 10 times more than the 25% that is the minimum for CANSLIM. And companies can inflate their earnings, making it look like they're having tremendous growth. However, they may have just been cutting costs in research and development or obtaining non-recurring profits. And this can make the EPS look like it's rapidly accelerating, while sales are just barely growing. So this is why we really consult the sales growth. And you should also be taking a look at profit margins as well for backup. On the platform that I'm using right now, which is called Market Surge, we can change the quarterly data block in the settings to after-tax margin, which is the same thing as net profit margins. And this just lets us know if the company is efficient with its production and how profitable the company really is. And we want to see all-time highs with the net profit margins. And this should also be accelerating. As we can see here, 49.9%, 55.3%, 58.1%, and 58.5%. This is a really, really good net profit margin. So another really great thing to look for is when a company is consistently beating the analyst's EPS predictions. If we check here, the latest quarter for Nvidia shows that it beat the analyst prediction indicated by the earnings surprise. Their EPS was 16.84% greater than the predictions. And this is a sign of a huge stock movement upward. As we can see here for quarter 4, ending February 21st for Nvidia, there was a really nice earnings gap up that bumped up the price as soon as the earnings were released. And this catches the attention of investors. So apart from Market Surge, another place to find quarterly earnings reports is on a tool like TradingView, which I've used in the past. And so by adding indicators like ESV dashboard, which stands for earnings, sales, and volume dashboard, we can see the same type of data seen in Market Surge, like earnings per share growth right here, and then sales growth, which is right here. So that's pretty much it for this video. Just to summarize, we want to see 25% or preferably more growth in the earnings per share, just as strong growth in the sales that are backing up the EPS, and then growth in the after-tax margin, which is reaching all-time highs. And then we also want to see the actual earnings per share beating the predicted earnings per share by analysts, which creates that earnings surprise that can catch the attentions of investors. Thank you so much for watching this video, and I hope to catch you in the next one where we talk about annual earnings. See you next time.